Good morning, everybody. Welcome to the Flow Show. A busy week ahead. Lots going on, as you've no doubt seen, and we'll be shown shortly. Morning, Kay. How you doing, mate?
Hey, morning, Ryan. Welcome back, mate. Hope you had a nice couple of days off.
Yeah, very nice. Thank you. Very nice.
Ryan's got his birthday over the weekend, so I trust it was a good weekend.
Yeah, all bar the football. Yeah, it wasn't too bad.
Oh, yeah.
Football yesterday was a bit crap. I left early. I had enough of it. Yeah, a bit of rubbish. But yeah, a small downer to the weekend and the prior week. But anyway, moving on from that. Less said about that, the better. Right. As I said, we've got a lot to cover today because there's a lot going on this week. Central bank data, end of month. Oh, tons going on, which we should look at. Let's get some of the data out of the way first. Let me get on the right page. Where are we? It's
Ryan.
Yeah.
Check your microphone that it's not well plugged in because you're coming over cracked at times.
Cracked. Okay.
Yeah, a bit cracking. Cracking noises. Okay.
Okay, give me a second.
No, this is okay actually now.
Yeah, we're okay?
Yeah, go ahead, mate.
You sure?
Yeah, go ahead. Go ahead. We can hear you.
Okay. Let me just click a button and see what happens. Is that any better?
Yeah, go ahead. Go ahead. We're good.
Right. All right. So, yeah, I was going to crack on. Start with some of the data that's been out this morning, particularly. Over in Australia, we had some retail sales looking fairly upbeat, month on month, 0.9% there. So some decent numbers from Aussies. However, they have failed to agree a free trade deal with the EU. This was some talks on the sidelines of the G7. This comes after 5 years of no negotiations. They've hit an impasse and have, well, for now, stopped talking. The main bone of contention was Australia's access to some of Europe's markets, including their meat markets for beef and lamb, which the EU has stood firm over, not willing to give an inch on that. So the free trade deal there is off as far as those guys are concerned. Coming over to this morning and the UK, we had mortgage approvals and some consumer credit data. Mortgage approvals, there were thereabouts, 43k. Mortgage lending was down a bit. So, you know, a lot of people probably just refinancing, a lot of refinancing going through rather than new mortgages and stuff like that. So a bit of a drop in mortgage lending there. This is something we'll keep an eye on because there's a lot of short-term fixed rate deals that are coming up shortly. Unlike the US that has 30-year mortgages, we have fixed rates for, you know, anywhere a year, 2 years, 5 years, that sort of thing. So there's going to be a lot of people remortgaging into higher rates. We need to see how that affects whether people cut down on mortgages rather than borrowing more. And it looks like potentially we're seeing a pullback in the amounts put in under mortgages as well. BOE consumer credit data, again, nothing in there flagging anything heating up. You know, we keep an eye on the credit card spend to see if people are putting more debt onto their plastic if they're finding the cost of living tough, but still no real significant flags coming from that one there. It's German regional CPI day today, and so far, as you can see from some of the numbers there, the year-on-year measures coming back down again, 3.7 from 4.1 for Bavaria. Pretty much a similar story, drops in all the year-on-year measures so far. GDP in Germany, the preliminary number quarter-on-quarter coming in at minus 0.1%, was expected minus 0.3%, so a win of sorts. But it does show a negative number nonetheless for Germany. The year-on-year number also not as bad as expected, which Both those numbers might be a bit of surprise considering the performance in Germany of late, particularly, as indicated by the PMIs that we've been watching. But not as bad as expected, but still a negative number puts them on course for a potential recession. But as we've been banging on about pretty much all year, I'm not expecting any big contractions in GDP. So, maybe floating around these sort of numbers for the next couple of quarters is a possibility. I'm certainly not expecting any minus 1% or 2% or anything like that. But we'll see how bad it does get if it does. But as I say, GDP numbers there not coming out too hot. Over in Europe, in Spain, CPI there as well. Was expected to rise. Spain CPI to 3.8% came in unchanged in the end at 3.5%. The HICP measure, the Eurozone measure, though, ticking up 2 pips. Again, not as much as expected, but still sticky inflation coming in to Spain there. Just looking at some of the ECB speakers now. The floodgates are open after last week's meeting. ECB's Nagel says inflation is still far from reaching our target rate of 2%, but our tight monetary policy is working. So a little less hawkish, we shall call that, from him. One of the hawks, ECB's Casimir, has a word or two to say about the rate holders. Saying additional tightening could come if incoming data force us to. And voices coining the end of the rate hike cycle should hold their horses. It's too soon to declare victory and say the job is done. So continuing to be very worried about inflation. ECB's Simca says there's no need for more hikes now, but in future we will see. Kay, has there been much fallout since the ECB meeting?
No, we had the we had the ECB meeting, which was widely accepted, and I would say the same thing as let's say a mildly dovish or unhawkish hold. And no, but since then we have had those bit of a mixed comments. It seems that Casimir is kind of reacting to Vujicic, the Croat, who said we are done. So there's a lot going on more to the eastern side of Europe. They don't really agree on what should be done. But as you say, the notable difference, I think, is the hawks, the real hawks, the core hawks. Let's put it that way. The bigger ones. And we heard already, and that's a good while ago from Knott, that he was not that hawkish anymore, that he was also looking at the transmission of the rate hikes. And then after the ECB spoke about that, we had those usual rumors, sources saying that, because that was one of the uncertainties, whether they would bring forward the discussion about the APP, PEPP, and whatnot, other abbreviations that they use over there. That hasn't been the case, and sources saying that they are going to talk about it over the winter. But over the winter, as I said at the time, means that perhaps we are not even going to hear it in the December meeting, because the December meeting theoretically is before winter starts. But okay, so that's been really what's going on after the ECB meeting. So I'm going to say a lot of nothing. We are not wiser, and they are not either. And it's what I said over the when Lagarde spoke on the Thursday. He said the press conference, as usual, could have been done in 1 minute, when she went okay, we are looking at the transmission and we are data dependent, and that's basically it.
Yeah. Okay. Cool. Thank you.
I didn't get anything. I found it a relatively dovish one, but then we cannot say that it's any different from what the global picture now is in the central bank market, that they are all data dependent, and so we have been talking about that already very often, and they just that was just a confirmation, right? But they are clearly shedding their hawk wings. So That's the normal evolution, we will say, right?
Yeah, and they like to punt the can down the road, so as not to give the market too much to take hold of, and that keeps their message in play. Rates are up, rates are staying up until they decide otherwise, and that's the message for
I
also
think that, what I said post ECB is that apart from a surprise hike and hold, well, rise and hold of CPI, I think they're done. And it's just the same as most of them, right? I mean, it's gonna take something, a really re-flaring up of the CPI for them to continue. Just if I may expand a little bit, we've already seen that yields have continued to go higher. Broadly, we have those usual big levels that are holding, right? But broadly, yields have been rising, and that is sort of doing the work for the central bank. So it's going to take a big CPI jump, in my opinion, for them continue to rise, because I don't know if growth-wise we can expect monster growth to continue. So from that side, data dependent, okay, but just looking a little bit more at the risks over there.
Yeah, very much so, mate. Right, we'll just catching up on a bit of data from Friday and some surprising data, really. Not so much from the PCE numbers coming in largely as expected there, but as I've spoken about before, because we had the GDP prior to that, which included at least estimations of these numbers. I'm not sure, was there much market reaction on Friday to these numbers? A little pip loss on that. I think the GDP PCE was a bigger mover, wasn't it?
Yeah, the people were virtually only reacting to the lower personal income. It does look like GDP, PCE included. The market really says like, okay, these are the last good numbers, and the dollar did not really advance much on it. I've got a big déjà vu from the U.S. labor report. You know, remember where the dollar gained 0.3% and then went the other way around. It looks like the market is really wanting to take it now that those are the last good numbers out of the US. I personally have still a bit of a different opinion, but I really voluntarily don't want to change my perception or boat too soon. Yeah, the market is looking like that. If you look at the numbers that we've seen of late, and then you go straight away, you look at the bond market and the yields market. The yields are not going any further. That is really a sign that the market says, well, okay, we had those bond gurus taking off their shorts, but more than that, I mean, the market is now looking at, okay, this could possibly be the last good numbers, and we are now looking forward to what's going to happen this week, right, with the ISM and the labor report. So
and what about this Michigan number down here, this inflation number? Because that came in even higher than the flash.
Yeah, I mean that was a bit of a crazy one.
I mean, that jumped from 3.2 to 3.8 in the flash, and then came in even higher on the final read.
Yeah, but is that going to take the Fed over the edge? I'm not too sure right now.
No, I
also,
doubt they're going to change.
it's
I doubt they're
also
going to
one
hike on this survey of 500 people, but it's still.
And if one looks at the data rankings compared to what they create as market moves, you have a little bit of a shock effect, an algo effect, and then that wanes over the Michigan, and unless you have like a really bonkers stellar report on the one hand, or a really crappy one on the other hand. I mean, if you look at, for instance, the consumer data, they were still a bit less and markedly lower than prior month, and that is, I think, the market is trying to put all those numbers into the basket now and put it through the mill and then see what comes out. And we may only really start to take a direction post what we are going to see this week. I mean, Yeah, it's not an obvious read, let's put it that way, because the market
Yeah.
does not really react more than for half an hour to the numbers that come out right now.
Yeah, probably nothing more than a bit of algo moves
Mm.
coming in there. Right, so let's just move on quickly. Just a bit of news in the automotive sector in the US. Apparently, the UAW leaders, the union leaders, have okayed the Ford deal that's been on the table. That's going to be included with some $8 billion in manufacturing investment, according to specialised news over there, automotive news. General Motors is said to match Ford's 25% pay hike, and so has Stellantis said to match that as well. So potentially some end to the strikes going on over there. However, that's not happening in Canada, where Stellantis workers are going to go on strikes after negotiations failed over there. So potential easing for some, as I say, the US auto industry, which some have already drawn that into Q4 GDP numbers as a reason why those numbers might pull back a bit because of the impact of those strikes coming into the later estimates for Q3 and into Q4. But that's way ahead. But the resolution there would be potential benefit for the US, as I'm sure we're all aware. Now, so lots coming. I looked at the Canada this morning and nearly went on holiday again.
Yeah.
Absolute tons out. We've got everything.
Yeah.
We've got flash GDP, we've got retail sales, we've got inflation data, we've got central banks, we've got PMIs, jobs. It really is a big one. It's almost too busy to properly trade, if you know what I mean. There's going to be moves in between all the data points. Any big variations is going to go one way or another. Probably the best advice I can give you for this is assess the data as a whole when we get to the end of the week. Obviously trade it in between if that's your thing, but don't take. And this, I'm going to point this to Ali, our mate Ali, who likes to swing a bit around the data as well. Don't take every number to mean that the narrative is changing 100%. If the Fed's on pause and we get a strong US number, doesn't mean they're going to hike Wednesday, and vice versa. Take it as a whole, what it means for the overall picture. Think about the growth race. Think about the cut race, which we've been talking about. Who's likely to cut first? Well, when you get US GDP at 4.9% and German GDP at minus 0.1%, you know which way the sentiment and bias leans for the dollar and for the euro, just based on those numbers. Doesn't mean you jump into a trade that way. It just means you follow who's the strong, who's the weak, and that's the way the market's going to look at it. Overall prices aren't doing an awful lot. Euro dollar's looking a bit bid even after the German GDP numbers. So it's not a straight trade, but factor in all this data in terms of what it means for economies going forward, because it does play into rate expectations. If the rest of Europe's GDPs are all coming in rubbish, there's no reason why you would step in and buy the euro just on that basis alone. And then if the market starts thinking the US may be cutting rates later than everyone else, or indeed Europe or the UK may be cutting sooner than expected, that's where you're going to get your trades potentially coming in. So anyway, the rest of today, not a lot on the calendar for the rest of the day for the US in particular. Tomorrow we get the Bank of Japan, among other things, the FOMC starting, and as I said there, more GDP from Europe, retail sales. So all those numbers are going to be watched closely as well. Canada GDP as well, house price data, US consumer confidence, New Zealand jobs. You can see there on the screen the tons and tons of data. So it's going to be, as I say, a bit difficult to trade a lot of it unless you're just sort of scalping in and out of the different numbers and the variation to those numbers. But let's go to the Bank of Japan because that's tomorrow. Have we seen a much in the way of front running possible? I mean, really, the only real thing, and you know, obviously, if you've heard differently, you've got different view, Kay. The only real thing we're looking for in this meeting is those forecast changes and potentially how high they put up those CPI forecasts. But as you know, as far as YCC changes or anything like that, slim to no chance, I would think.
Yeah, it's there's a couple of things going on in my opinion. So first of all, base case is they don't change monetary policy. There is a decent percentage of a chance that they do something with the YCC again, especially if they raise those CPI forecasts. Raising those CPI forecasts, I think we've got reasonably speaking, a lot of or enough hints that they really may review that. So that's something that the market likely already factored in. Then we have to look at what moves we are seeing. We're seeing the JGB 10s, which is the main point, which is the main measurement, right? We see them gradually ticking up to that 1% allowed. If they revise inflation higher, we're probably going to hit that 1%. Now, then we are going to go back to look what happened over the prior meetings. Because even when they widened the YCC, we had that extra 100 or 150 points move in the dollar yen from 139.5 to 138 at the time, if I recall correctly, and then it massively took the other way around. I mean, that is probably where we stand again right now, with that difference that the other central banks are probably done hiking. So if there is any difference in the price action that we could see, is that it may go slower than before. I don't think we are going to, if they keep everything unchanged, right? Or if they just review and do something to the YCC. I don't think we're going to have the 500-600 point moves that we have seen prior in dollar yen, unless they really start to change stuff like rhetoric hawkish, YCC changing, and then bringing us much closer to monetary policy change. We're still in the same, how shall I say, playbook. We're still playing this or out of the same book as we've been saying for months now, is that they are on the way to gradual normalization or changing, how one may call this. But it's all about the speed of the things that they will do. Because even if they which the market thinks that it could create a shock if they put the rates from minus 10 BP to zero, I would still expect it to be only a temporary move of the yen higher, because you're looking at zero interest rates where the rest is at 4-5%, right? So that is still going to be a factor. The question is still going to be: Are we going to be able to stay long yen for longer? That is what the market is going to be wondering about, because it's somewhere clear. I mean, there's a reason why we are at 150 and not at 140s, because not a lot of market is really playing yen from the really short side, apart from the longer term players. I haven't seen many. Apart from myself having been most of the time long dollar yen, whether it's cash or via options, but I haven't seen many people really saying like, oh yeah, dollar yen is going to 160, or I want to be short yen. And that's likely one of the reasons why we are here. But on the other hand, I've heard a lot of people saying like, yeah, 150 is the top, 145 is the top. And oh yeah, now what we're seeing the last couple of days, we want to be short Swiss yen. Those kind of things, that the market is still looking to be long yen. Now, the question will be, are we going to be able to stay long yen for longer? That is really the question in this market. If the answer to that question is no, then I think we are going to see a similar reaction as what we have seen over the past Bank of Japan meetings, but slower this time, because the rest of the central banks is at the end of their cycle, and the Bank of Japan is probably going to do more.
Yeah, I think any YCC change, I mean, the market, if those forecasts do go higher and significantly higher, and the YCC is because of that. Any YCC changes because of that, then that's one thing. If they change the YCC just because, and they've been speaking about this, the pressure of just yields in generally as seen around the globe, then they're going to sell that as this isn't a monetary policy move. This is just a market functioning move, like they did the first time they changed YCC. And then the market certainly won't be buying yen on that message. I think it's a case if you do see a headline popping up, YCC is widened, and you see yen strengthen, there's probably a good chance that that's going to reverse pretty quickly, and that might be a bit of a fade trade to look at. I think I don't know if I'm going to be up for it, but I might park a couple of cheeky bids down in the 148s or something, just in case we get something like that happening.
And the other thing that I've seen like end of last week is this article about the Japanese insurers, and they have said that if there's not too much change right now, if they see the moves of the Bank of Japan still to be slow, then they may buy more unhedged foreign bonds, which would have a more direct impact on the yen than when they hedge those bonds. And that's actually a yen negative if they would start to press a few buttons in November.
Yeah. So I wanted to ask about dollar yen, because I had another crack at trading the break. It didn't last too long. Managed to get some pips out of it this time though, but then gave a bit back on the balance. It's still, we can call this, it's still holding really, isn't it? We've had a little bit of a stop clear out up there, but yields turning hasn't helped, I don't think, but it's proving a big old level up here. Has there been any sort of official, unofficial, chatter again about this 150 level?
Yeah, I mean, everybody's wondering, but again, I mean, the last reaction when we were above 150 and then spiked below is just apparently a BOA article saying that they think that they are going to change YCC, and that caused the dollar yen to drop 100 points and 100 something points, and then we recovered to mid 150 and a half, and then since then I reckon it's rather what's happening on the US yields, and I'm really the market's wondering about what the Bank of Japan is going to do. But again, if you look at it in those moves, you may say yes, and as I said, there's a lot of talk about Swiss yen starting to turn around. A couple of those currencies like euro yen is not going for the 160, but then you talk about those levels, and then you notice that you say like, okay, euro yen is capped up there, and now we are lower. But look at where euro yen was 2 months ago or 3 months ago. If you look at more for the medium term, look at where we stabilize. I mean, and then you don't talk about your 10, 20, 50 points even. You talk about big figures there. If you look about, you don't even have to go back to March, April this year, because that's like really a huge move. But take for the longer term players, then you take those levels. What's changed for them? Zero, nothing at all. You have the volatility in yen, which is relatively high nowadays, and I warned about that back in 2022. I said there's going to be more volatility in some markets because of the higher yields. Higher interest rates always create a bit more volatility than when they are low. But that's exactly what's happening. So yes, you have these 150 points in the yen, but then you stop, right? And you hold like pretty important levels. If you take away that last spike beginning of October, you look at euro yen, for instance, and euro being one of the weaker as well, you're still well above 155, 156, right? That's what I mean with the longer term. If you look at the dollar yen, we're 30 pips away from 150. We are not trading where we were trading when the Bank of Japan widened YCC at 139 or 140. We're trading at 150, and so we have to put everything in context. I'm going to say if they really start to change monetary policy, then there's going to be a big move, in my opinion, in yen, regardless whether the yen interest rates are at 1% and the rest at 4 or 5%. There's going to be a big move because there's going to be big flows on the back of it. Okay, and then probably the yen is going to stay stronger for longer, especially if the rest of the world is starting to show a little bit less growth and inflation continues to come up, for instance. But for as long as that doesn't happen, look at the levels where we are and just take the lessons from it and I'm still not in the camp to start buying yen for the more longer term. It's and against whatever Bank of Japan may do, or even Ministry of Finance, because everybody's now having wet dreams about Bank of Japan changing monetary policy and then MOF putting another yen 10 big figures lower. I mean, if you look at the other side of the middle, the government is still pushing for with more stimulus plans. Okay, I mean it can keep inflation higher for longer, but they are watering down the finances, so that's a yen negative as well. So
Yeah.
it's
Just to answer Ali's question, can 150 be attacked if they keep unchanged tomorrow? Yeah, I think if there's absolutely zero change, if the forecasts aren't revised higher as expected, no change to YCC, we very may well put in another attack on 150. And the question is going to be, the question each time at this level, this 150 level, okay, is if it breaks, can it hold the break? Okay, we tried to break there, it didn't last. Okay, so that's your key price action. Okay, this is trading 101. Okay, you've got one big level, 150. It's a big line. Okay, if you get above it and you hold above it, then you're going to go higher. If you go above it and can't stay above it, then you're going to be heading lower. The question is, how lower do you go? So, yes, we could go 150. We could go up and match these highs again on an unchanged Bank of Japan. But if we get a retest of 150, that's your key. If it starts to hold there, and there was, tentative signs when we came back down there that it was going to hold, but it didn't. It bounced to near 20s and then collapsed. So if it can't hold the level, then, you think, right, well, we're back under. Maybe I'll try a short up against 150 and, 20, 30 pips, I'll be taking profit off of that because we know that the dips are very shallow. So there's no point, shorting it here on after a failure and thinking it's going to go to 146, 145. The evidence tells you over the last few months or last few weeks that it's not going to go there. And the longer you sit in that trade waiting for a move lower, the more it's going to cost you money on the carry being that way. So, you can scalp it for a level. Hold it for a few days, but if you get 3, 4, 5 days in and it's not breaking down through 149, then you got to think, well, how much longer are you going to bleed money? And then you just job it between the levels. But if you get a break above here and it holds, then you've got some conviction to try along. If you get a retest, if it hasn't already blown up, and then you give it a go, and you have a tight stop under 150, pretty much like I did last week, except it didn't hold, and so I got stopped on the balance underneath. If it had carried on going, I would have been sitting here long and everything would be pretty, but it didn't happen. But that's how you play it. You use that 150 as your level, your right or your wrong level. Yes, mate.
To me, the 150 is not very clear, to be honest. It's more like the question post Bank of Japan, if we get volatility, is are we going to cap again between somewhere 151 and 152? That's really my question. If it caps naturally, then we probably see the medium term top again for some time. And the same thing is going to be asked the question if we go back to somewhere around 148 or so, 148, 147 mids. If we see it there and then it starts to hold, that's going to be the other question. I don't think the question is really 150, but I see how you explain that for the level to hold or don't hold. I think this week actually, as in general, is going to be either you are a sniper and you take positions for 15, 20, 30 points and you take your profits straight away, or you are already in more medium-term positions, or you see a pattern play out that gives you a more medium-term idea about where things is going to go, taking all the data into account and the central banks into account. But anything in between, if you try to anything in between is probably taking the risk of getting stopped on 30, 40 point stops. So that's how I see this week starting to at the start of the week anyway.
Yeah, no, it's very much so. And that, you know, 150 isn't, in the grand scheme of things, it isn't a big number, it isn't a big level. And I'm the same as Kay, you know, 152s was a big level when we were in this rally, because that was a big 38.2 fib, you know, multi-year fib at that level. And that's the level up here. 152 is the big level, not 140, 150, 80, 151, 20. All those bits and pieces in the middle are nothing. But the reason I'm highlighting this with 150 is because it doesn't matter the number, it's the price action. You can use this number as your pivot level, okay? Because the price action is showing you that. So if it's staying below 150, you can be confident with shorts, but you've got to be careful how much you want to leave it on for, because the dips, as we were saying, are very shallow. So you're not going to be getting 300 pips necessarily shorting at 150, but you can make 10, 20, 30 pips if you've got the patience. The same if you're long and you get a break above, you know, fine, it could go to 152 again. Brilliant, absolutely. But what do you do if it doesn't? Where's your line that says, okay, I'm wrong if I'm long above 150? It's 150. So it's just enough. It's not 150.10, it's not 149.98. You can use 150.
And then there's plan B. Don't trade the Bank of Japan.
Yeah, don't trade the Bank of Japan.
Because I mean, I'm just saying that because I see what Horatio is saying. I'm nervous about dollar yen long, but you can be equally nervous about dollar yen shorts if the Bank of Japan is only a lukewarm meeting and we grind higher to 151, 152. Are you going and you're short? Are you going to stay short? I mean, you can be as nervous about shorts or longs, dollar yen. I mean, it
depends where you're long. You know,
yeah,
if you're long at 149.70s or something, yeah, you're going to be worried. You know, 20, 30 pips off that 150, or forget 150. You're going to be worried going into the Bank of Japan having a trade right on market when you know there's big volatility.
Yeah, but I think there's clearer trades if you look at it from the global picture. Let's say there's going to be clearer trades than that, and I'm thinking about one in particular, which is euro dollar. You're looking at 104.80, 105 on the one side, and 107-ish on the other side. You're in the middle of it. But if one of those two break, I think we are in for a couple of 100 points moves. But in yen, it may be so much more muddy than this.
Yeah, exactly. I mean, I'm still in the same position for dollar yen. You know, for something more than just a scalp or a short-term intraday trade, the only levels I'm looking at is whether we get a move above and hold 150, or we get a move down to 147 and see what happens down there. You know, that's the sort of area I'd look to get into a long that I'd want to, you know, potentially sit on for a while if the price gave it to me and if the price performed. You know, I could buy at 147 if we got down there, stop at 146.75, and boom, I'm done. 25 pips, no harm, no foul, whatever. You know, I haven't risked a lot. But if I get that trade down there, that may be something that I can sit on and then try and see if we get 150 again. Then you get in some decent pips. Otherwise, apart from maybe a bit of jobbing and scalping around, like I say, a couple of cheeky bids for the Bank of Japan sub 149, I'm not interested in messing around in the middle here. These are my levels. That's why I keep trying to break at 150 or I'll wait until to buy it at 147 if I like it down there. So yeah, but take the volatility into account. You know, for the Bank of Japan for this week as general, take this volatility into account. If you're not sure about trading it, if you're a short-term trader who would be trading these levels for 10, 20 pips, and you've got all this flood of data coming through this week, you know, set yourself wider. You know, see where the market is at the end. Rather than jump in the water in these choppy seas this week, sit on the side and see if the water's calmer after. See if we've broken new levels. See if by the end of this week we're above 150, 151 or whatever, or we're below 149, 148. See if euro dollar's above 107 or below 105. And then start to plan your trades. So if you don't want to get caught up in the mess, sit on the sidelines, see where prices are. And if we're still in ranges, if we've moved up to 107 in euro dollar this week again, but we haven't broken through come Friday after the NFP and whatever, then the range is confirmed and it gives you your levels to trade. You know, you don't have to guess, oh, if I buy it here, it's going to 110. Well, it may do or it may not do. And you just have to make your trading decisions based on that. So there's nothing wrong with keeping on the sidelines for a bit, staying out the water if it's too choppy, and just seeing what the price does in between. And then you can come back in when things are quieter and you can get back to trading your 20 pip scalps in and outs or whatever you want to do. Right, Kay, do you want to have a quick look around?
Yeah, but yeah, sure. I'm going to show stuff that really moved quite a bit, and because I mean, taking a look at everything at the start of this week is going to take us far too far. I just want to start with some of the big movers of late. Gold is one of them. With the Middle East situation, there's been a clear flight to gold, as we've already been saying. We flew through those 1930s here. Interesting to note is that we stopped. Of course, the 2K is a psychological number, but interesting is that we can put some picture on it, and you stopped somewhere in between the 23.6 of this prior move and the 78.6 of the move that we saw back down from 2000s down to the lows that we've seen. We stopped there on the 78.6. So it is going to be a relatively interesting level, I'd say, for the start of this week. There's been well, there's regularly, the situation is so fluid. Some evolutions as well in the Gaza Strip. Israel is making moves. The rest are reacting and commenting. Even China is now commenting versus the US as well. So that keeps the geopolitical picture very muddy. So I'm not excluding that we are going to have a look above, but
I was going to ask quickly, if I may, just looking at the shorter term price action, it looked like yet another Friday. Let's all jump into gold, and then Monday, nothing's really massively happened. Let's get out a bit. Similar to what we've seen pretty much every Friday so far. You know, these little late runs into gold.
Yeah, that's your short-term reaction. But then if you look at it from like a bit more technical, we had this shit. That's the prior move.
The bid remained in gold, definitely on the geopolitical stuff. Yeah, just the short-term moves mixed with the longer-term thinking.
Definitely, because if you look at it before we printed the high, we went that spike higher, and then it corrected right down to the 23.6 we spoke about, and then started to move up again. So that is still, if you look at it from a little broader perspective, not the long term, but from a little broader perspective, that is still telling us that the countries, I mean, people who are buying gold, or the market is still not how shall I say, not very confident with the situation, right? The thing is, though, is that as I said, and if you look at what's been coming out as articles and stuff, is that I think part of this move is China again. That they came back into the markets, and it does look like they waited a little bit and then they come in the market again. So I think this time we again have to look at this 1950s, 1960s zone. If it starts to hold there and we're starting to move higher again, despite much evolution in the situation in the Middle East, that to me will be a clear sign enough that they are still over there, still in it, you know. So that the silver also moved a lot, but yeah, I had a problem again with my charts. They've been reset to prior dates, and I don't know why that happens. We're a bit moving in between the goalposts here, in between this 23.40, 22 and a quarter. This is probably going to be a range to watch. Stretch it to 23.75. The big zone, though, if we start to break above 24.5, this is going to be off to the races. Until then, I'd say there is still a reason enough. We are going to have economic data over this week. If those data are perhaps a little bit weaker, the real economic data, silver may not enjoy too much of it, and there may be a case for waiting for those low 22s. But I do agree with what Gregor told us at the end of last week, that somewhere in the low 22s, this may be a really good zone to reflect on what's going to happen next. Euro dollar, we've already spoken about it. I don't know if this is something valid, but with the neckline here, I'm rather looking at, and it's looked a little bit double bottomish as well. 105.25, and then, as I said, the big zone here, 104.80 figure. In the short term, if we start to trade back above this 106 figure 15, we're probably going to push higher to the 35.50. But then the big zone is going to be 107, right? So that's your 200, 230 points to look, I think, the extremes for this week. If you start to go outside of those and it's starting to hold, then I think a new move is upon us. But for as long as it doesn't do that, you trade the edges and you trade the ranges. I'd say this is something tradable, those ranges. A bit similar on the sterling, although sterling is still a little on the defensive. Sorry, you see this line has been moved again. Yeah, it's a bit more on the defensive. It's kept more on those trend line levels. I think first little zone here, 121.60 to 80. And then you start to talk about the 122. And again, but again, the big levels are around here, right? Somewhere between 122.5 and 123. And the big level on the downside is here. If you start to break below those lower levels, test of the 120.40 on the cards. But these are going to be levels that we watch out this week, because we do have economic data out. We do have the Bank of England out. So if you're somebody more patient, I guess we are going to trade those edges at one stage, and then we see what really has to be done with everything. Yen, Ryan already showed the yen. I'm not going to show this. Just look at those differentials. We are still mooching around. That's what I'm saying. I think there's still little reason to be wanting to trade the euro dollar higher, because we're still hanging pretty low or pretty wide in the differentials. So that's probably going to cap the rebounds, going to keep us in a range. But they're not like widening enough to say like, okay, this is a fresh move starting in euro dollar, for instance. And you look at what the moves have done in the euro dollar, they are still roughly coinciding with these. We are in end of month territory, so there may be moves away from this strict pattern, but globally we are still hanging pretty wide. Sterling even more. I think this is still looking a bit weak for the sterling. This is going to be an very interesting over the FOMC and Bank of England. If they continue to widen and we don't get any disasters on the US numbers, this to me looks like we are preparing for a bit of a break here, wider. So that means deeper in negative territory. So wider spreads in favor of the dollar. If this confirms this week, cable is probably going to break lower. And you know what? I'm going to stop it here, Ryan.
Thank you, mate. Yeah, so busy week ahead. I hope we've got touch paper lit with all the analysis today. We'll obviously be assessing the Bank of Japan and what happens overnight with that, and looking ahead at some of the other things up and coming for tomorrow. So once again, I wish you a great week ahead. Trade safely, folks. I don't want to hear any horror stories from you guys and girls. Thank you as always to K-Man. Yes, Alexandro, we will see you later on F.A.C.E. And but for now, have a great day, everybody, and yeah, we'll catch you tomorrow.